All right, guys, so we're gonna do a little candid video, and it's mainly gonna be on inflation rates. A lot of people are talking about inflation rates like it's a really bad thing and like it's about to get super bad. Well, with inflation rates, it's one of those things to where it's what it causes is what matters. Inflation rates actually cause high interest rates. It's one of the tools that the government uses in order to lower these inflation rates. Let me go ahead and give you the definition of inflation. Inflation is the rise of the price of goods and services, reducing the purchase power of each unit of currency. Rising inflation can be harmful because prices are higher. Consumers may also lose purchasing power. So the TLDR with inflation is that goods and services go up while the amount of dollars that they're making when they're working stays the same. So basically your dollar can buy less is the TLDR on it. So there's different things that can be done to combat this, but the one that's the biggest one that's used is interest rates. Interest rates rise and people become more conservative. It's just the nature of the beast and how this works. The best way to understand this is a credit card. When you guys go get a credit card, or anyone who gets a credit card, they just start by buying things with cash. But then they realize, oh wait, I can buy this cool plastic thing with this little plastic thing. This is fun. Let me go and start using a credit card. So they start using the credit card and they're super disciplined. They do a good job. They pay their bills. At the end of each month, they pay the full bill, not the required minimum. You know, the classic one that always shows up, but the full balance doesn't ever seem to show up until you look deep into it. And then you're like, oh, that's how much I really owe. Yeah, people were disciplined back then and paid the full thing. But then people started to splurge and were like, hey, wow, this cool new item. I'm not making a lot, but they have this minimum payment thing. I can now have this cool luxury item, so let's just go on credit. So then they go on credit and they're making these monthly payments where they really aren't even paying off the actual item itself. These monthly payments, they're really just paying off interest, which when you buy things on credit card and you're doing the minimum payment, you almost pay for that item like 3 times over based on the interest rates that they charge you with these credit card payments. So with this in mind, people are literally living paycheck to paycheck and they're making the minimum payment every single stinking time. And there's no wiggle room on that. If they lose their job, or if something happens, or if they need to buy something else because something comes up, like their car busts and they got to make a new repair, it's not going to work. They can't do it. They can't push the limits. They've already pushed their credit cards. This is how you can relate in the crypto markets with these VC funds and hedge funds locking up and basically not having anything that they can do but become forced sellers. So when they become forced sellers, this causes these cascading liquidations, which causes others to go bust. So it's not because the company wants to go bust, it's they are a forced seller. So if we go back to initially where we started with the company that is literally going paycheck to paycheck, as in it's literally going on a limb. And an example of this in the crypto market is it's depending on Bitcoin to stay above 40K. Because if it goes below it, well, its loans are going to be below board and those get liquidated, which liquidates other positions as well, which will then liquidate other VC funds because they're depending on them to pay. So this causes them to go bust. Now, you don't really know who else will go bust until other things go bust. An example of this was Luna. We really didn't realize who else would go bust until time goes on. And now we're starting to see like Celsius, Three Arrows Capital, these guys are starting to go bust. Now, this also goes back to the same example that I gave you. We don't know who's going to go bust after these guys. The crypto markets are interconnected. And actually, let me give you an example with Three Arrows Capital. This is what they were doing. Well, at least rumored, and I'm pretty sure it is correct. What they were doing is they were funding these different projects. They were investing in them and saying, hey, look, we'll help you out. We like your project. Let's go and invest. And then what they did after some time, or even just right after they invest, they say, hey, we'll manage your treasury for you and we'll help you earn a percentage on that. So we'll give you a yield on it and we'll manage your treasury. We're like, yeah, that's awesome. So they give the money back to Three Arrows, and now Three Arrows has this money. Again, what do you think they do with it? Do they throw it in Aave and earn a yield, or they just hold it, sit on cash? No, they use it to invest in other funds. So then you have more leverage in the system to where what is the real money there? Well, nobody knows. And then you have these cascading liquidations that make these funds go bust. Now these funds, like Three Arrows Capital, they also may have invested in other funds. So Three Arrows Capital is unable to pay or make good on their debt, or the treasury assets they were managing are now bust. Those companies that normally would be okay if they just held their money, they go bust too. And when they go bust, who else? Like, did they invest in someone else? Well, then they go bust. So right now, it's one of those things, we don't know when the dominoes are going to stop falling. So the summary of this video is inflation causing rising interest rates does a couple of things. The first is it creates forced sellers. Forced sellers are usually the best opportunities to buy into things. It's because they have to sell at a super cheap price. It's like someone moving out of a house because they have to. They have to relocate for a job and they don't have enough time to order movers. They're happy just to get pennies on the dollar, just to get something out of it instead of leaving it, because normally if those movers can't show up and they got to move out of the house, well, the stuff is just going to stay there. So they're happy selling it pennies on the dollar. Second is we're in a risk-off environment. People are not willing to go out there, buy Bitcoin, buy Ethereum, buy these different altcoins, or the next 100x gem if they can't put food on their table. That's something important to keep in mind. So it's a risk-off environment. The third thing this creates is a cascading liquidation event. This causes further liquidations to happen as more and more people get liquidated. Now, what should you take from this video? It's entirely up to you what you want to do, and this really depends on your time horizons. The best deals come out when forced sellers come out, period. It's because you can get the best deals. It's not because they're trying to make a profit, it's just because they're trying to get pennies on the dollar. So if your time horizon is a long-term time horizon, opportunities like this are used to dollar cost average. Me personally, I think it does go down further with the ripple effect that's going on with the people that are going bust, because we don't know who else is going to be affected by this. I already have crypto exposure and I'm fine with the exposure that I have, but if the discounts and the deals get much lower, I would be interested in deploying more capital. Now is one of those times to where, me personally, I would be more comfortable buying at a higher price when I have more certainty around the market. Right now it's uncertain, and yes, I do have a longer term time horizon, but I feel there's better deals to be had. I hope you guys enjoyed this video. Sorry for like the little candid video, but anyways, just time for some fresh air, and let's go ahead and hit you guys with that wisdom one-liner. Proverbs chapter 13 verses 1. A wise son heeds his father's instruction, but a mocker does not respond to rebukes. Man, dude, I relate big time to this. My father actually told me, it wasn't the top of the market, but it was at the first sell-off. He was like, it's coming down, son. You need to sell a lot of your positions. I didn't listen. I sold a little bit, and I took some profits into UST, and I was like, yeah, this will be all right. You know, drink the Kool-Aid, think it's awesome. And then you sit back and you're like, wow, Father, you know nothing about crypto, but yet you are a very wise man. Anyways, guys, thanks for tuning in. We'll see you in the next one.